For those of us who put petrol in our cars, we've noticed the drop-off in the fuel price, and that's been good news driven by softer oil prices worldwide. For the South African economy, it's potentially a blessing that could boost the economy. For countries like Nigeria, analysts are warning that it may need to seek funding from the IMF because it costs it a lot of money to produce oil in that country. This is Tonight. I'm Bruce Whitfield. Tonight we look at the biggest winners and the biggest losers of the lower oil price. Joining me from Cape Town, Brooks Spector, who's Associate Editor at the Daily Maverick, and in Johannesburg, Alence, who's an Associate Professor of International Relations. He's Acting Director at the Centre for Africa's International Relations Department at the University of the Witwatersrand. That's a big title. To you in Cape Town first this evening, Brooks Spector. It's nice to have you with us. What are the Saudis playing at? What is OPEC playing at? They made the big announcement in November that they would maintain production at 30 million barrels a day, and the oil price, which not so long ago was trading around $110 a barrel, has scuttled all the way down to the region of $70.
Good evening, Bruce. I mean, it seems as if they were playing for market share rather than revenue. I mean, part of the problem, of course, is that there are lots of new players in the petroleum market who aren't OPEC members, most especially, and this is the key perhaps, the United States or North America more generally, where the oil sands and the oil from fracking in the United States and Canada is generating a growing amount of oil into the market outside of the OPEC marketing, and at a certain point, of course, it becomes clear that the United States is going to be virtually energy independent, which removes even further impact of the OPEC pricing strategies. So in a sense, they're running a bit scared, those folks in OPEC, because they worry that down the road they will lose market share, and if you lose market share, ultimately you also lose all the income that comes with that. So this was in some ways you could argue it was the best of a bad set of decisions, and that's the one they picked. But of course there are implications. For you, me, and everybody else who drives a car up to a petrol station, this was wonderful news because the price has dropped, and there's at least some sense that it's going to keep on dropping for a little while yet. That translates into lower fuel costs for us all. Individual consumers come out ahead, but some countries, of course, that are enormously dependent on that revenue, they're not quite so happy.
We're going to talk about that in just a moment. I need to understand, though, from you, Brooks, in terms of the impact that $70 oil, $60 oil, $50, some people are speculating, has on the fracking revolution, the shale gas revolution in the United States.
Well, there are a lot of people who say that the cost of lifting oil out of the fracking fields and the oil sands fields, obviously there's a cost involved with that, and below a certain point it's no longer profitable to do it. And some people have said somewhere in between $60 and $70 a barrel equivalent. The problem is, or the challenge is, that this set of technologies is constantly being improved, efficiencies are being brought into it, so it's not absolutely clear to me that there's a bottom limit that we're approaching yet. It may well be that ultimately these companies will be able to produce their oil, their petroleum, at rather less than the price people think the international market for oil is going to reach. If they can continue to do that, then the pressure continues on the OPEC nations to market their oil. That's going to be that's going to be one of the key developments, in fact, to watch. And part of the problem for anybody analyzing this, the technologies are relatively new, the economies of scale are significantly new, and no one absolutely knows what the ultimate cost is going to be to show profitability from fracking or oil sands. But clearly people still think it's profitable.
Brooks Spector is in Cape Town. Alence is in our Johannesburg studio. He's from Wits University. He's an expert in Africa and Africa relations. And it's really interesting to see the fear factor come into countries like particularly Nigeria, but a number of West African economies, countries like Angola, for example, heavily dependent on oil revenues. Oil north of $100 is manna from heaven for them. Oil at 70?
Yeah, I mean, I think Brooks has pointed out some of the important differences in the interests of consumers and producers of oil. Obviously, low prices are going to be great for consumers and not so great for producers. But in this range that we're in now, I think the economic break-even point for most producers is very safe, and I agree with Brooks that the shale production that's up already is quite safe at this level. The problem is that many governments have become so dependent fiscally on the oil revenues that even though they can continue to run a profit pulling oil out of the ground, they're unable to balance their budgets. And so Venezuela is kind of the classic case of this, but Nigeria is also one that's really facing a squeeze, because again, even though they can make money from oil at this price, they've had to do some major changes in their 3-year expenditure planning just over the past few weeks.
I mean, in South Africa, our tradition is to do things terribly slowly until we suddenly do them. We've got the thing called the MPRDA, the Mineral Petroleum Resources Development Act, which has finally caught up with the 21st century, and we were going to launch oil exploration off the coast of South Africa because our geological structures are apparently similar to Ghana's, which has been very successful in offshore oil production. We're looking at fracking in the Karoo. Does oil at $70 make that sub-economic to go and start the exploration?
Yeah, I think we're looking at such long time frames. I know the deep offshore oil, they're talking 20 years down the line where it would actually come on stream. So I think the kind of fluctuations that we're seeing now are not going to be a major consideration in terms of those long-term investment patterns. I mean, we have to remember, it seems like a big slide in the oil price, 30–40% in about 5 months, but on average, this has happened about every 5 years for the last 3 decades.
No, thank goodness for the consistency of trends. Brooks Spector, what does this mean for geopolitics? I mean, this is your game. You love a bit of geopolitics. Wars have been fought in the Middle East over oil security. The United States more energy independent than it's probably ever been in its history. It takes the pressure off the United States to be the global policeman role that it has fulfilled for much of the last 100 years. But it does then open new doors to new superpowers to play that global policeman role. How important is oil in geopolitics right now?
Well, the thing I would mention, if you want to talk geopolitics, is that the place that gets the most pressure put on it by this trend is not the OPEC nations necessarily, and not even the countries that Rod has talked about in Africa, although I absolutely agree that the pressure is really on a country that gets 90% of its government revenues out of oil, and when the price drops 30%, that puts a real hole in their budget. But interestingly, the country that has the most concern right now is probably Russia, because Russia's major source of international hard currency earnings comes from energy, and primarily that's petroleum and to some degree natural gas. And to the extent to which that budget, that revenue for its budget also drops, is the extent to which it puts a real crimp in their ability to pay for imported goods, for the kinds of consumer goods the Russians are now relatively accustomed to having, and it puts real pressure, so people are beginning to argue, on Vladimir Putin's plans to increase its interest, increase its energies, increase its activities in what the Russians like to call the near abroad, that whole periphery of countries that used to be part of the Soviet Union but are now independent countries, and at which little bits and chunks of such countries like the Crimea, Transnistria, Abkhazia, or in Georgia, have been nibbled away at over the last number of years, to the extent to which the Russian economy begins to falter because of the oil price and because of the sanctions from the West because of those incursions, is the extent to which there is more pressure on Vladimir Putin to somehow rein in its costs, or at the minimum try to somehow pull back a little bit from being the new expansionist, revanchist government that many people charge it as being. So that's one geopolitical angle. The other one, of course, is to the extent to which countries cannot finance their plans and cannot provide their social welfare expenditures out of decreased oil revenues, a place like UAE, the United Arab Emirates, or Qatar, for example, the stability quality of those countries begins to be, to some degree, put at peril. So those are, I think, are the two key geopolitical lessons we can draw out of this. The United States, to some degree, isn't in the search for oil imports, as you've noted, but it's still going to be interested in the stability of oil supply to the larger world, from the Middle East, from West Africa, and so forth, and from Venezuela, of course, as well.
That's some of the global stuff. I mean, if you are the president of an African country and you're oil dependent on oil revenues, how concerned are you right now, Rod Alence?
Well, if I'm good like Jonathan, I'm pretty concerned. Over the past couple of weeks, they've had to downgrade the benchmark price twice.
They've revalued their currency, they've raised interest rates in Nigeria, and that's before we saw the big drop.
Yeah, and there's elections in February.
Yeah.
So there's a lot of things piling up. I mean, I think Brooks is right that the Russian situation, probably from a global geopolitical perspective, is a big one, and there's estimates that say that the decline in the oil prices actually hit Russia 2 to 3 times harder than the Western sanctions have. But I think when you start to look to the big African oil economies, they've all kind of sort of had calibrated their budgets to higher oil prices, and there's an adjustment process now. So you're seeing depreciation of the currency, and you're seeing the need to make budget cuts, neither of which are the kinds of things that you want to do if you're coming up on an election.
Does this underpin, does undermine the Africa Rising theme that we've been sort of tied to in recent months?
Well, we've got to remember that Africa's got a few very big oil exporters, but for the bulk of the region actually are oil importing countries, net oil importers like South Africa. And for that group, I think that having cheaper oil will help to kind of stimulate economic growth.
Forgive me for being selfish, but I'm quite enjoying lower oil, and so is the family budget. Brooks Spector, the Associate Editor at the Daily Maverick, and also Rod Alence from Wits University, my guests this evening on Tonight with Bruce Whitfield. Thank you, gentlemen, in Cape Town to Brooks Spector, and in Johannesburg to Rod Alence. Thank you very much for joining us, and thank you for watching. The complexity of the oil price. You win some, you lose some. For the African continent, it's a very complicated issue. For the Russians, it's triply complicated. Till next time, bye-bye.